So if you bought into Berkshire Hathaway, thinking Warren Buffett is just some stock market magician, you might be missing the real magic trick. Today, we're going to pull back the curtain and show you what really makes Berkshire tick.
Most people, right, they look at Berkshire and they just see this gigantic investment fund, kind of like a fancy S&P 500 where Buffett is your personal stock picker. But is that really the whole story?
The thing is, the reality is so much cooler. Berkshire is way more powerful than just a fund. Think of it less like a mutual fund and more like a business empire, one that almost has a license to print its own money. So, how on earth does that work? Okay, let's dive in.
Okay, to really get Berkshire, you have to wrap your head around one single word: float. This little word, it's the secret engine behind the whole thing.
So what is it? Well, put simply, it's all the cash that Berkshire's insurance companies, like Geico, collect from you and me in premiums. They get to hold on to all that cash, sometimes for years, maybe even decades, before they ever have to pay it out in claims. Let's try an analogy. It's actually pretty simple. Imagine you open a pizza shop. But here's the deal. Your customers pay you today for a pizza that you promised to deliver next year. Now think about it. For a whole year, you're just sitting on their cash. You can use it for whatever you want. And as long as you eventually make that pizza, that money was basically a free loan. That is float. And this, right here, is where you see the huge advantage. I mean, if you or I wanted to invest a bunch of money, we'd have to go to a bank, right? Get a loan, pay maybe 5-7% interest. But Buffett, he gets to play with billions of dollars of this float. And get this, if his insurance companies are run well, the cost of that money is basically zero. Sometimes it's even less than zero. I'm serious. If they take in more money in premiums than they pay out in claims and costs, he's literally getting paid to hold other people's money. It's insane. All right, so you've got this giant mountain of free cash. Now what? What do you do with it? Well, this is where the real art comes in. The art of moving that capital around. See, a typical fund manager, they've only got one move: buy stocks. That's it. But Buffett, he's playing a totally different game. He's got two major plays. Sure, he can take that cash and buy chunks of great companies like Apple or Coca-Cola. We all know he does that. But, and this is the game changer, he can also use that float to buy entire companies outright. Just gobble them up and make them part of the Berkshire family. And these companies he buys, like the BNSF Railway or See's Candies, they basically become these amazing cash cows, just churning out profits year in and year out. And here's where it all clicks together. A normal CEO, what do they do with profits? They might just hand them out as dividends. But not Buffett. He looks at See's Candies and says, wow, you guys make a ton of cash, but you don't really need it all to grow. So he becomes this master capital mover. He can literally take the profits from the candy business and funnel them over to the railroad to build new tracks. Or he can just take that money and buy more Apple stock. He moves it where it can be used best. And that right there, that's the true essence of Berkshire Hathaway. It's not just a pile of different assets. It's this living, breathing ecosystem where cash flows from one part of the business to another almost without friction, feeding whatever part of the empire needs to grow. Okay, this sounds like the perfect business model, right? I mean, who wouldn't want this? So why isn't everyone doing it? Well, because there's a really big hidden danger. You see, this whole beautiful machine, it only works if the insurance businesses are profitable, or at the very least, breaking even. And in the insurance world, there's one key number that tells you if that's happening. It's called the combined ratio. And if that number creeps above 100%, that's a massive red flag. Huge. Why? Because a combined ratio over 100 means for every single dollar you bring in from premiums, you're paying out more than $1 in claims and other costs. All of a sudden, that free money isn't free at all. In fact, it's now a money-losing loan. The whole engine starts to run in reverse, burning cash instead of making it. So this is the real takeaway. Buffett's genius, it isn't just about picking winning stocks. It's about the incredible iron-fisted discipline he has over his insurance businesses. He's famous for saying he'd rather let business walk out the door than write a single bad insurance policy that could poison the well. And that discipline, that's what makes Berkshire more than just a holding company. It makes it a fortress. Okay, so let's bring it all home. Let's go back to that first question we asked. When you buy a share of Berkshire Hathaway, what are you really buying? You're not just getting a piece of Coca-Cola and Apple. No, You're buying into the whole system. You're buying a piece of this brilliantly designed, self-funding machine that runs on basically free money, all directed by one of the most rational capital allocators in history. The real question now is, in a world that's always changing, how long can this incredible system keep going? And can anyone else ever hope to copy it?